All right, welcome to Financially Speaking with SFM. I'm Dan LaForest. This is Daniel Corson, and we are both wealth advisors here with Security Financial Management. Today's topic is the 60-40 portfolio. Now, Daniel, a lot of our clients, who especially in retirement, are a moderate risk tolerance, and a 60-40 portfolio really kind of fit their needs for a number of years.
Absolutely right. And just the 60-40 portfolio, which is 60% stocks, 40% bonds, has always been the de facto portfolio to use as for the moderate investor. Some may call it more of an all-weather allocation. But just as the equity markets have been in and out of favor, so has the 60-40 portfolio. There's countless articles over the past year and a half of the death and the rebirth of the 60-40 portfolio.
No, absolutely, and we see a lot of those moderate type portfolios, but let's take a rewind. Let's take a look at what happened here with the marketplace here over the last 12 to 18 months, where we've seen portfolios dip in a moderate type anywhere from 15 to 20%. You're right. A lot of people look at risk aversion as that bond and cash area as a safe haven, but that hasn't been the case, has it?
No, definitely not in 2022. Not only when rates started to rise in March of 2022, but if you go backwards a few months to the end of 2021, when we had the anticipation and the expectation of interest rates rising. We all knew that the Fed was going to raise rates. And so typically stocks, bonds, you put them together. Why? Because they are inverse to each other. Well, last year, that was not the case. The markets moved together. So if you have traditionally, stocks go down, bonds go up, vice versa, that did not happen last year. Why? Because we saw, for the first time in I would say 35 years, we're now in a rising interest rate environment, but not just a rising interest rate environment, interest rates and inflation that we have not seen in decades, not since the 1980s. And so when you have that kind of inflation, the bond market is going to react negatively.
Let me comment on that real quick, is the fact that, we talk about that 40%, which is bonds. One of the things that a lot of clients don't understand is we're actually looking at how they're invested in certain bond categories, whether or not they're invested in short-term bonds, long-term bonds, or moderate. What does that really mean?
Great topic, because you were mentioning stocks and bonds as if all stocks are allocated the same or all bonds are allocated the same. That's not the case. You can invest in different pockets of the market, whether it's stocks or bonds, and we divide these up into different categories or asset classes, however you may want to call it. To answer your question about bonds, you have short-term bonds, mid-term bonds, long-term bonds, and they're all affected differently by different rates. So let's just say, for example, we anticipate rates rising, which they did going back a year and a half ago. In that case, you want to adjust from more of a longer duration exposure to bonds to a shorter duration. Why? Less impact. A few weeks ago, or maybe months ago, we talked about the banking crisis and what was one of the factors that hurt the banks. Well, one thing is they were holding way too much exposure to 30-year bonds. What did the 30-year bonds do? They lost 30% last year because they had the most vulnerability to higher interest rates.
So what you're telling me is the longer I hold a bond, there's more risk associated with that?
There is. Because think of I use the seesaw scenario of, rates go up, bond prices go down. The farther you go out in maturity, the more susceptible you are to having that inverse reaction without increasing your risk.
No, absolutely. And let's talk a little bit about that bond exposure. Just like you would look at an equity portfolio with how much international exposure versus a U.S. large cap or small cap or value, you actually have long-term bonds, short-term bonds. And when we've seen somewhat of a recovery here, it's been the 60% of our portfolio that's bounced back with the equities. The 40% still struggling.
It is still struggling, although it has come back and has stabilized versus what it was a year ago. You can't look at the stock market as a whole, the same way you can't look at the bond market as a whole. For example, with bonds, you have long-term bonds, short-term bonds, intermediate-term bonds. They're all susceptible to different rate cycles. And we can get into that. And just like with stocks, value dividend-oriented stocks tend to be more attractive in rising rate environments, whereas growth stocks tend to be more attractive in lower inflation and lower rate environments. But as the yields rise, the bond prices are going to remain lower. And so yes, you are getting a higher yield as those bonds mature, but that's going to take some time to cycle out.
Yeah, and a lot of people don't look at it from a timing standpoint. They look at the short-term problem instead of the long-term solution. And especially in a 64 portfolio, there is a rebirth, because if you're investing new money, the damage has been done with those bonds. Mm-hmm. And even if we do start seeing those interest rates dropping here in the future, that's only going to bolster that. But it still doesn't help the people who are stuck in that mode. So, Daniel, when we meet with clients, what are some of the things that you're talking to them about of taking a little bit more risk, but at the same time, they're not really taking a lot, we're just giving them more equity exposure?
Correct. You have to look at and investing according to different cycles that we're in. So you're talking about the last, 12, 18 months, and I mentioned that the 60-40 portfolio had negative real returns. Well, what's real returns? That's when you compare returns versus inflation. So if inflation's in the mid to high single digits, you're going to have high return to counteract that. So when's the best time to be in a portfolio like this? When inflation is declining. So have we reached the maximum inflation? It appears we most likely have. Inflation is coming down. It may not be coming down as fast as everyone would like, but it is trending down. And historically, that is the best time to be in a 60-40 portfolio.
We can actually give you more equity exposure without increasing your risk tolerance. So, a lot of people have asked us is, when is the right time to make these moves? And that's a conversation we have with our clients on a regular basis, because you can shift risk tolerances, you can shift allocations at any time. And that's something that we talk to them, because even though we want to look at investing from a long-term perspective, there are some occasions where we have to make some short-term adjustments, isn't that right?
Well, with risk comes reward. And what's riskier in the bond market would be those long-term bonds. And if you remember back in March, we had a banking crisis. I believe everyone remembers that. We even did a video on it. And so what was one of the main detriments and what caused a lot of problems for some of these small regional banks is they were going out and buying 30-year bonds in order to get a higher rate of interest. And last year, 30-year bond did what? It lost, 30%, right? Just like if you were invested in the NASDAQ and the tech sector. So you don't think of bonds moving like a stock, but they do. So if you're going to have a period of rising inflation, rising interest rates, do you want to own long-term bonds or short-term bonds? The answer is definitely short-term bonds. So just making adjustments within an asset class can make a big difference.
Daniel, I've got new money. If a client has new money, is a 60-40 portfolio still maybe something to consider if I'm a moderate type investor?
I think for a moderate investor, a 60-40 portfolio is a good starting place. It's a great core, and then you can always build around that based on different cycles that we're in at the time. You don't want to just have a boilerplate portfolio assuming that we're always in the exact same market cycle, credit cycle, interest rate, and inflation cycle each year just like the next. As you know, things change in markets. And so a good starting place would be the 60-40.
Yeah, and I think that's a good point because, we encourage our clients to call us on a regular basis to ask questions about their portfolio.
Yeah.
It may be a situation where you're in good shape based on the economic environment, but we can make recommendations to help you improve it along the way. And I think that's a problem for a lot of people in the financial world is, they think, oh, I've got this, but they don't understand it fully, and they don't understand that their advisor should be there for them to make periodic changes.
That's absolutely correct, because the market's going to react differently, whether we're talking about stocks or bonds, based on rising inflation, lower inflation, range-bound inflation, which likely you could say we are in. And for those of you that may not have heard that term, range-bound, so for example, we saw 9% inflation, we're easing down. Are we going to hit 2% inflation like the Fed wants? Eventually one day, but it's unlikely anytime soon. So odds are we're going to stay within some sort of range. Probably not getting back to 9%, but staying in that mid-single digit range. So we have to think and base our decisions on that scenario.
There's so much that you can do as an investor. It's just about getting the information. And that's what Daniel and I and the other advisors here at Security Financial Management are here to help you do. So give us a call. We'll sit down with a complimentary meeting to help you analyze your portfolio. I'm Dan LaForest. That's Daniel Corson. You're watching Financially Speaking here at SFM. And we'll see you next week.